It's John observation here. What we witnessed today was not just another volatile trading session, it was a historical moment that very few people truly understand yet. Gold moved over $300 in a single day. To be precise, gold surged roughly $311, marking the largest one-day dollar gain since 2008. That kind of move represents an estimated $2 trillion shifting hands in a single session. Let that sink in for a moment. $2 trillion, roughly the entire market capitalization of Amazon, repositioned without a CEO announcement, without an earnings call, without a board meeting, without guidance, and without permission. This wasn't driven by corporate performance or investor sentiment toward a single company. This was the oldest form of money on Earth, reminding the modern financial system that it still exists and still matters. Gold closed up approximately 6% on the day, nearly $286 per ounce, while silver exploded higher by roughly 14%. And when gold, silver, and copper all move together in this kind of synchronized fashion, this is not speculation, this is not retail hype, and this is not a meme-driven trade. This is the system repricing what money actually is. Jesse Livermore once said that markets speak long before headlines explain why. Smart money listens first and asks questions later, and right now, the market is shouting. What almost nobody is connecting yet is what's happening behind the scenes in the physical market. Physical silver is becoming extremely difficult, borderline impossible, to source. Bullion Star recently confirmed that the physical market is under serious stress, especially silver. Mints are closed, refineries are backlogged, most competitors are effectively empty. Bullion Star still has inventory because they planned ahead, but even they are adjusting premiums to reflect real-world physical scarcity. They've lowered buy and sell minimums from 20,000 to 10,000 Singapore dollars and are monitoring conditions closely. Access to physical metal matters, especially during times like these, because paper price volatility means nothing if you cannot actually source metal. In yesterday's video, I discussed the possibility of a move toward the $87 to $90 zone in silver. At the time, silver was trading around 80. That level wasn't random. It represented a confluence of technical factors that I won't fully break down here because that alone could be an entire separate video. Price didn't hit that level yesterday, but today it did, and it was rejected. That rejection matters. On this channel, we don't chase hype. We analyze scenarios using real data. No greed, no fear, just preparation and planning. If this approach helps you, hit subscribe and drop a comment with OG John AG so I know the real community is here. Roughly 70% of this channel consists of long-term investors, decades-long stackers, while the rest are shorter-term traders. That's why we cover both the physical reality and the paper market. Different strategies, same goal, planning instead of gambling. As I'm recording this, Western Silver Spot and futures are trading around $85, while Shanghai Spot is near $100, Shanghai futures near 101, creating a roughly $15 premium, about an 18% premium. A few days ago, I warned about a critical technical level. If price closed below the 150-hour exponential moving average while trading above $100, we could see the low 90s as potential support. Price initially bounced exactly as discussed. I then followed up with another scenario related to the Fed chair's potential impact, explaining how we could push even lower, possibly below 86. That wasn't a signal, it was a scenario, and as we saw, it played out. Now, here's the critical level everyone needs to understand. The same 150-hour EMA that helped guide the 86 and below scenario is now sitting around $96. After an 18 to 20% bounce from the lows, I'm already hearing people calling this a confirmed bottom. I don't do that. I don't pick tops or bottoms, and nobody consistently can. Anyone claiming insider certainty at this point is offering entertainment, not analysis. Here's what the technical picture actually shows. A complete washout in contract open interest typically correlates with market lows. With February contracts rolling into delivery and limited roll activity, total COMEX gold open interest dropped to roughly 414,000 contracts, the lowest since June 2025. COMEX silver open interest also collapsed to about 142,000 contracts, the lowest since May 2025. These are classic capitulation signals. Weak hands flushed. Leveraged longs liquidated. But here's the catch. The 150-hour EMA is now resistance, not support. We're trading roughly $11 below it. We hit the 87 to 90 target, and were rejected. Bulls tried to push through, couldn't hold, and got pushed back down. That rejection is important. It tells us real resistance exists there. Let's break down both sides clearly. On the bearish side, the 150-hour EMA at 96 is downward sloping resistance. When support flips to resistance, that's a bearish technical signal. If we fail to reclaim 90 and hold, we could see another leg lower, possibly retesting the $71 lows. Bitcoin has already dropped below 74,000 for the first time since April 2025. Risk-off sentiment is spreading. The S&P 500 closed down nearly 1%. Nasdaq dropped 1.5%. The Wall Street Fear and Greed Index is back in fear territory. Global bond yields are spiking. Germany's 30-year yield just hit the highest level since 2011. U.S. 10-year yields are approaching the highest levels since August 2025. Japanese yields are near levels not seen since 1999. This is systemic stress. When bond yields spike globally, everything initially sells, including metals. Add escalating geopolitical risk, including reports of potential U.S. conflict with Iran, and you have a highly volatile environment. Initial reactions to war are almost always risk-off. Sell everything, raise cash, wait for clarity. Only later does the safe haven bid fully kick in. That means even bullish fundamentals don't prevent near-term volatility. Now the bullish case. Physical silver is extremely scarce. Mints closed. Refineries backlogged. Dealers empty. Bullion star reducing minimums just to maintain access. This is not paper volatility. This is real-world supply stress. You cannot fake closed mints. Central bank gold demand remains relentless. Central banks purchased approximately 328 tons of gold in 2025, following 345 tons in 2024. Poland led with over 100 tons, followed by Kazakhstan. That marks 33 consecutive months of central bank buying. This is a structural shift, not a trade. Credible analysts are raising, not lowering, targets. David Hunter raised his gold target from 5,500 to 6,800 and silver from 125 to 180. Meanwhile, COMEX open interest sits at multi-month lows. Classic washout conditions. Forced selling is largely complete. History shows us what volatility looks like in currency crises. During Germany's hyperinflation from 1914 to 1923, gold rose 1 billion times, but experienced monthly swings of negative 30% to positive 160%. Volatility isn't the problem, it's part of the process. The mainstream narrative claiming that a new Fed chair somehow invalidates the gold bull market is nonsense. Billions of people in China and India don't base savings decisions on who runs the Fed. The gold bull thesis hinges on debt, currency debasement, physical supply, and demand, and none of those fundamentals have changed. The 5,600 area in gold and $70 area in silver hold historical significance as support. Whether they hold long-term requires confirmation, but the conditions for a major bottom are forming. The Chinese yuan is strengthening against the dollar. Pricing power is shifting east. Physical premiums remain elevated, even after a 40% crash. So is 71 the bottom? Here's what matters. If silver reclaims 90 and then the 150-hour EMA at 96, that's confirmation. If it fails, more volatility is likely. Physical scarcity says the bottom is close. Paper markets say patience is required. This is war-driven, headline-driven price action. Leverage kills accounts in environments like this. Even physical holders must understand premiums can compress quickly. Nothing is guaranteed. If you're a long-term stacker, this is noise. The only questions are availability and premium. If you're trading, every level matters. Know your risk, know your plan, never assume certainty. Invest with logic, not hype. Do your own due diligence. Use your own brain.